Swiss luxury group Richemont owns several of the world's leading jewellery, watches and writing instrument brands, including Cartier, Cleef Arpels, Panerai and Montblanc. It's controlled by the Rupert family and has made great progress in sales in China. It has a market cap of 308 billion rand, a price to earnings ratio of 20 and a dividend yield of 0.8%. And this one has proved defensive even through an economic downturn.
Yeah, it's been a real rocket. So it came out of the Richemont Rembrandt restructuring back in 2008. It was around 15 rand. The financial crisis hit us. It fell down into the single teens and then boom, yeah, it is trading at 60. So it's one of the most successful stocks on the market. It's really been because China has experienced a shift away from infrastructure-led investment to a more consumer-driven story. Plus, Chinese are big on gifting, and they've also become big on traveling. And they go and they travel and they spend a lot of time in duty-free, and then they go on shopping expats.
So let me put this into the picture. The Chinese are actually boosting sales for Richemont in Europe.
Exactly. People who go to the Cartier store in Paris will tell you it's full of people from China. They come in by the busload. So they are benefiting from lower excise duties because it costs more to buy those goods back in China. But they also go to Hong Kong and to Macau in order to do this. But look, Johan Rupert, very cautious, very conservative, very strong balance sheet, all the right attributes.
Gary, let's get your thoughts on Richemont.
Richemont as well, yeah. I think Paul's spot on Richemont. I mean, we saw a little bit of a wobble on Richemont there. It came off, and that was when at least they released so the Swiss export for watches was down a little bit. Guys got a little bit nervous ahead of the earnings. I mean, we've got earnings coming up now, and I mean, they've already given guidance. They're going to be very strong again.
Is there more upside to this stock if it's trading at around that 60 rand level?
Yeah, we'll have to see where the earnings come in, but I think there is. I mean, like Paul says, the fundamental case for it going forward is very, very strong. You've got, I mean, if you look at it, you said in the beginning of the intro that it's a very defensive stock. It is defensive, and it has performed well through recessions, just because you can see the gap between rich and poor getting bigger. I mean, their market being the uber
because the rich don't stop spending.
They don't stop spending.
In an economic downturn.
The thing is, when it comes, yes, an economic downturn, it'll be very defensive. A full collapse, it's going to fall apart completely. So it does look like it can do more. I think especially looking at how the world's progressing now, I think we have got more upside in this counter.
Well, we're not looking at the end of the world, so it probably is going to hold its defensive nature. Or are we? I have no idea.
No,
are we looking
far
at the
from
end of the world?
In fact, in China, they're about to have their once-a-decade leadership change. And people said, oh, this could be tricky, maybe there'll be some instability and, things could change. Turns out it's like the old classic elevator at the airport, the one that goes horizontally. As the one old dead Chinese man falls off the front, another whole bunch of new ones come back. Same people, conservative, very stable, very oriented towards political stability, keen to get consumption going. So I don't see any negativity there. About the only thing that I don't like about Richemont is the dividend yield, which is quite low, partly because the Swiss government eats up 30% of it or something.
But it's not enough of a negative to walk away from this as an investment story.
No, because for me, the opportunity really is to get into one of the world's kind of premier consumer companies. Yes, it's trading at 60 rand, but I wouldn't be surprised, given its euro earnings, to see it earning somewhere in the region of 5-6 rands a share 2 years out.
Is this one to buy now, put into the bottom drawer, and look at it in 10 years' time?
I don't think you need to wait 10 years, to be honest. I think you probably wait a couple of months at that trajectory and be banking profit. But no, I think yeah, Paul's spot on. It's a great business, and especially the brands and the technology behind those brands, the skilled craftsmen that make the watches. I mean, it's not easy to replace. It doesn't have people that are coming to be competitors with it. And as long as there's rich people that want sort of luxury goods, it's going to do well.
Hot or not, Gary?
Hot for me.
Hot or not, Paul?
Hot.
It gets a thumbs up from Mr. Paul Toronto.